from now. Interest rate risk, right, the process or the thing that ultimately affects this value has two parts to it: price risk and reinvestment risk. Price risk is the change in price that happens when interest rates change. That's what we've been talking about over the last couple of slides. Long-term bonds are going to have more price risk than short-term bonds. They're just more sensitive to these changes. Why? Because ultimately they have a longer period of time for that price risk to incorporate into the return of the investment, if you will. Reinvestment risk, though, talks about what happens to cash flows as you receive them moving out. And of course, if interest rates are rising, then future reinvestment rates will be higher. So short-term bonds have more reinvestment rate risk than long-term bonds. They're going to be more sensitive to changes. Why are they going to have more sensitivity? Because in the end, they don't have enough time to react to these changes. The high coupon rate bonds are going to also have more reinvestment rate risk, because obviously there's more of a change that's possible. The net impact of all this is that whenever interest rates change, both of these things happen to bonds. There will be a price risk impact, there'll be a reinvestment rate impact, and they are opposite in sign. So when interest rates go down, price risk, or the price, goes up. That's obviously good for us. But when interest rates go down, reinvestment risk also goes up. But what it means is future cash flows are not going to earn as high a rate of return, and that's a negative number. So we need to have a way to kind of analyze and deal with this interest rate risk. And one of the techniques, or one of the things that we can talk about, is something called duration. And duration measures how sensitive bonds are to changes in interest rates. How much does the price change? And I don't want to go through the formula, but essentially we have it listed right here. Here's that bond we were just talking about, and you can see here it has a modified duration of 8.79. The bigger this number, the more sensitive the bond is to interest rate changes. So down here we say if there was a 1% change in yield to maturity, this bond would change value by negative 8.8. So let's see if that makes sense. If the interest rates go up, what should happen to bond prices? Bond prices should go down. So that's why it's a negative 8.8%. So the new price is ultimately going to be $820.81. So we can measure how sensitive corporate bonds are ultimately to changes in interest rates, and we understand how that's going to ultimately affect the value of a portfolio or value of any investment. We've talked about corporate bonds off and on. The primary difference between corporate bonds and Treasury bonds is just the riskiness of the debt. And primarily what we're talking about is the risk of default. Excuse me. Investors will pay less for bonds for credit risk than they would for a default-free bond. Well, why is it? Well, because they're taking risk. If you want somebody to buy something, nobody wants to take on the risk of default. Nobody wants to buy that. So how do you get people to buy something that has this bad thing with it, this bad characteristic? Well, the only way you can do that is by having them pay a lower price. So the yield of bonds is obviously going to be higher for bonds that have default risk than for bonds that are default free. So we can divide bonds into some categories: investment grade bonds and speculative bonds. Speculative bonds essentially are what we also refer to as junk bonds. If you talk to a bond trader, somebody that works in the industry, they really don't want to talk about themselves as being a junk bond salesman, right? They talk about themselves being a high yield security salesperson. What does that mean? Well, it's a high yield means high risk. Yield means bonds. So they're a speculative bond person. That's what they deal in. The investment grade bonds are typically AAA rated down to BBB rated. And here's ultimately where we can use some information to try to figure out what rate of return would be good for us. What rate of return should you expect to get? So if you have a AAA rated bond, well, what if we did this? Let's go to Yahoo Finance. If we go to Yahoo Finance, let's go to the bond section. And I think we may have looked at this or talked about this a little bit earlier. But here are the Treasury securities. So a 30-year Treasury security is 3.67%. So if you were to buy a 30-year trade, that's what you would get. But what if we look at the composite bonds? Let's look at the variety of different types of bonds that you can buy. And this doesn't list all of them, but it does give us a pretty good picture of some of the differences in yields for different types of ratings. And obviously I'm waiting for Yahoo Finance to give me some information here. Whoop. It just didn't work. Sorry about that. So let's go back. Try one more time. Composite bond returns. Here we go. Sorry about that. But if we go down, here's Treasuries. We just saw that. Here's municipals. And then down here you can also see that they have them listed by their grade. So a 20-year AAA rated bond is going to earn roughly about 4.28%. So if you were going to buy a AAA rated 20-year bond, what yield do you think you should expect to get? Well, the average is about 4.28%. So guess what? That's what you're going to get. If you bought an A-rated bond, you would expect to get 4.86%. You wouldn't expect to get much more. You wouldn't expect to get much less. So this is the rate that we can use in trying to determine what required return you should get on debt. Speculative bonds obviously are more risky. They're the bonds that have the B's, the C's, the D's. In fact, somewhere down here, these C's and D's, they might actually already be in default. So you probably don't want to invest in those. In fact, they refer to these investment grade debt. This is probably the only kind of debt that an individual investor should ever be interested in looking at. Once we get to these speculative bond issues, the risk is extremely high. What about default spread? Again, how can we use this information? We've talked about something called the yield curve, and we've looked at what the yield curves looks like. But what about the yield curves for different levels of risk? So here we have three pictures. The yellow line is Treasury yield. The blue line is United States Industrials, they're AAA rated bonds, and the green's BBB. Guess what? These will always be in this order. The Treasury yield will always be at the bottom. The BBB will always be above the AAA. That's just the way it's going to be because of the risk level. If they ever flip-flopped or did something weird like that, that would be a huge opportunity for making some trades because one way or another, something is obviously mispriced. But another thing we can look at is say, well, what's the average difference between these? And you look at the Treasury and the AAA, there's bigger difference lately, but there's really not that much difference between the AAA and BBB. So if you knew the relationship between AAA and Treasury, you could just add a couple of more percent and you would know what you would think you could get for the BBB. So we could ultimately predict the yields on bonds over the next 10, 15, 20, 30 years just by looking at a picture today, right? So if you were to buy a 30-year bond today, you would expect to get these yields for the three different risk levels. There is debt that's obviously offered by companies or countries other than the United States. United States securities are typically considered to be default-free. No other asset, no other country in the world offers things that are not default-free. And in fact, if you look at what's happened over the last couple of years, many European countries have started to declare essentially defaulted on their debt. So how do we ultimately deal with the concepts of international debt? Well, if you're worried about what happens to the credit risk, I mean, that's just another thing you have to evaluate. You certainly would expect sovereign debt, not United States debt, but debt from other countries, to have higher returns than United States debt. You may even expect some of that sovereign debt to have higher returns than some very good corporate U.S. debt. So anyhow, the purpose for showing and talking about international debt is just to bring in the idea that, you know, there is debt outside the United States that, number one, we can invest in, and number two, that we need to have an understanding of how the overall riskiness of those economies by looking at those values, looking at the returns, etc., that they pay. And finally, we're going to do this in class, but I want you to take a look. We can go to this website. It's the FINRA website, the website that's ultimately it's actually the regulatory authority, and they have a section where you can go to investors, right? If you go to market data, you can actually go to bonds, and you can put your company's number in here, right? So we can put in, change this to corporate, and I've been following CORE, so that's TAP. So if I just put in CORES there and hit search, I can see what the debt is of CORES. You can see here we have essentially 4 pieces of debt, and actually as of this day, which is 8/9, this debt's no longer in existence. That's been paid off, that's matured. So now they have 3 levels of debt left. They have a 2% coupon, a 3.5%, and a 5% coupon. This debt matures in 2042, 2022, 2017, and their debt essentially is this BBB rated. So, in fact, the S&P 500 has that BBB minus. So let's kind of go back. Where does BBB minus fit into this rating system? Well, there's double A's right here, or double B's. So here's BBB, and it's at the very bottom of this. So CORES' debt is just right above the level where you might want to consider it to be investment grade debt. I think that's the end of this chapter. We will certainly talk and do some examples and things in class. I will see you in the next chapter.